Hi everyone, today we're going to talk about one of the most powerful investment strategies out there, the dividend snowball effect. As well as discuss how to open and monitor your new dividend-focused portfolio to create passive income and reach financial freedom. As always, if you value the information provided in this video, please hit the like button, and if you haven't done so already, consider subscribing to my channel. It is entirely free. We're going to explore how the dividend snowball effect works, why it's such a powerful investment strategy, and how you can use it to build a passive income stream. So, without further ado, let's get started. What is the dividend snowball effect? Simply put, the dividend snowball effect is the process of reinvesting dividends from a stock into buying more shares of that stock, which, in turn, generates more dividends. Over time, this can lead to an exponential growth in your investment and a significant increase in your passive income. For example, let's say you invest $1,000 in a stock that pays a 4% dividend yield. That means you'll receive $40 in dividends each year. If you reinvest those dividends by purchasing more shares of the stock, your investment will grow, and you'll receive more dividends the following year. Assuming the stock price remains constant, you'll now have 1,040 shares and your annual dividend payout will be $41.60. If you reinvest that amount, you'll buy even more shares, leading to even more dividends the following year. Also, if the company increases the dividend percentage in the following year, you could earn even more dividends. Some companies have been known for annual increases. Over time, this snowball effect can compound and generate a significant increase in your passive income. And the longer you reinvest your dividends, the more substantial the effect will be. Why is the dividend snowball effect so powerful? There are several reasons why the dividend snowball effect is such a powerful investment strategy. Let's take a look at a few of them. 1. Compounding interest. The power of the dividend snowball effect comes from the principle of compounding interest. When you reinvest your dividends, you're essentially earning interest on interest. This can lead to exponential growth in your investment over time. 2. Passive income. By reinvesting your dividends, you're creating a source of passive income that can supplement your regular income. As your investment grows, so too will your passive income stream, providing you with financial security and stability. 3. Diversification. Many dividend-paying stocks are large, established companies with a track record of stable growth. By investing in these companies, you're diversifying your portfolio and reducing your risk. 4. Inflation hedge. Dividend-paying stocks are often seen as a hedge against inflation. As the cost of goods and services rises, companies that pay dividends tend to increase their payouts, providing investors with a hedge against rising prices. The compounding magic of dividend snowballing. Let's take a hypothetical example to illustrate the power of the dividend snowball effect. Let's assume you start investing $200 per month in a dividend stock with a 4% yield and you continue to invest for 40 years. We'll also assume that the stock's dividend payout grows at an average rate of 6% per year, which is a reasonable assumption given historical data on dividend growth rates. In the first year, you invest $2,400 per month, and earn a 4% dividend yield, which translates to $96 in dividend income for the year. Instead of taking that income as cash, you reinvest it back into the stock by buying more shares. Let's assume the stock's price remains constant at $50 per share, so you're able to buy 1.92 shares with your $96 in dividend income. At the end of the first year, you now own a total of 49.92 shares in the stock, 48 shares from your monthly investments plus the 1.92 shares you bought with your dividend income. Assuming the stock's dividend payout grows at a rate of 6% per year, the dividend yield on your investment will also grow over time. After 10 years of monthly investments, your portfolio would be worth approximately $40,767. You would have invested a total of $24,000 over the 10-year period, and your portfolio would now generate around $1,657 in annual dividend income. After 20 years, your portfolio would be worth around $101,982, with an annual dividend income of $5,250. After 30 years, your portfolio would be worth approximately $238,494, generating an annual dividend income of $12,292. And after 40 years, your portfolio would be worth an impressive $532,014, with an annual dividend income of $27,504. That's right, you could potentially generate over $27,500 in annual passive income just by investing $200 per month and letting the dividend snowball effect do its magic. This example doesn't even include increases to your monthly investment amount. If you increase the amount invested per month to say $500 or $1,000 per month throughout the years, the snowball effect could kick into high gear and dramatically increase your annual dividend payout. Of course, it's important to remember that this is a hypothetical example and actual investment results may vary. However, the dividend snowball effect can be a powerful tool for building long-term wealth and generating reliable passive income over time. How to get started using the dividend snowball effect. Now that we understand the power of the dividend snowball effect, let's take a look at how you can get started using this strategy. 1. Open a brokerage account to start buying dividend stocks. There are numerous brokerages such as Robinhood, E-Trade and Webull. Check the description below as we have linked some brokerages for you to check out. 2. Choose the right stocks. The first step in using the dividend snowball effect is to choose the right stocks. Look for companies that have a history of paying dividends and increasing their payouts over time. These companies are often referred to as dividend aristocrats. Companies such as Coca-Cola, Johnson & Johnson and 3M with 25 years in a row of increasing dividends annually are known for their stability and reliability. 3. Reinvest your dividends. Once you've chosen your stocks, it's important to reinvest your dividends. Many brokers offer dividend reinvestment plans, DRIPs, that allow you to reinvest your dividends automatically. This can help you maximize the power of the dividend snowball effect. 4. Hold your investments. The key to making the dividend snowball effect work is to hold your investments for the long term. The longer you hold your investments, the more time they have to grow and compound. Don't be tempted to sell your stocks in the short term, as this can interrupt the snowball effect and limit your potential returns. 5. Monitor your portfolio. While it's important to hold your investments for the long term, it's also important to monitor your portfolio regularly. Keep an eye on your dividend payouts and the performance of your stocks. If a company's dividend payout starts to decline or its financial performance deteriorates, it may be time to consider selling your shares and reinvesting in a more stable company. Stay disciplined. Finally, it's important to stay disciplined when using the dividend snowball effect. Stick to your investment plan and avoid making emotional decisions based on short-term market fluctuations. Remember, the key to success with the dividend snowball effect is to focus on the long term and let compounding interest do its magic. So, there you have it, the power of the dividend snowball effect. By reinvesting your dividends and holding your investments for the long term, you can create a reliable source of passive income that grows over time. Just remember to choose the right stocks, monitor your portfolio regularly, and stay disciplined in your investing strategy. And if you're looking for more investment advice and financial tips, be sure to subscribe to the channel and click the like button if you enjoyed this video. Comment below with your dividend investing goals. Do you want to invest $200, $500, or $1,000 per month? Also, do you have goals of early retirement, or are you planning on working till your retirement age? Let us know in the comments. Thanks for watching, and we'll see you in the next one.